Hello, hi, good weekend. It's Adil bringing you a intermarket analysis perspective on the US markets. Okay, let's try and understand the fundamentals first and foremost before we obviously look elsewhere. Okay, right, before we focus on technicals, fundamentals, always look at the currents and the bias and the sentiment and obviously the news flow in the market. Okay, so basically what happened? We had a very strong jobs number. Okay, so that obviously, even with regards to wage growth as well, it was very strong. So overall summation, strong, obviously jobs number that, as you can see, resulted in a strong pop in the US dollar. And I did highlight a HNS formation, a potential break of this channel or break of this key trend line. Obviously, we've gone bounced back up and we are making this right shoulder now as we speak. Okay, so this is where we are. Okay, so there we are. That's where we are. Okay, so we're making this potential right shoulder, and whether or not this transpires, we'll see. So basically, the daily chart, obviously, as you can see in the US dollar index, bounced exactly that trend line, and it'll be very hard for us to break down now, given the fact that the jobs data was very, very strong, and everybody started to talk about a rate rise being priced in much sooner now, much quicker than expected. And it'll be very hard for the Fed now to actually talk down the dollar, although they have started already. You did have an individual come out and talk the dollar down. So for example, if I can look at the actual quote, 1 second. Okay, so basically we've got median probability for June hike estimated by US primary dealers is 42%, obviously higher now, and the 2015 rate hike probability estimated at 80%. So obviously that's not good in terms of the 17 of 19 US primary dealers see at least 2 interest rate hikes by 2015. So basically the whole concept is interest rates are going to rise. It's very hard for the Fed to justify not to do so. It ruins his own credibility. And given the fact that the ECB is doing QE and given the fact that the RBA is talking their currency down and has had a rate cut, and obviously the RBNZ is attempting to talk its currency down. Obviously the yen we already know. So the only lone wolf in town really is the US dollar. So hence the reason why it's rallying. Okay, there was a quote. Obama. I mean, even Obama himself acknowledges wages are increasing. US poised for a good year. These are all dollar supportive. Okay, so all hawkish comments. Now, Lockhart, although we had Mr. Lockhart come out and says he's more concerned about downside risks to inflation expectations rather than upside. So these individuals are going to be sent out now to give out dovish comments. Fed's Lockhart doesn't rule out asset sales. We're not expecting asset sales to be a major activity. Okay. Let's have a look. Again, rate hikes. Lockhart, rate hikes will be a vote of confidence in the US economy. Also a sign that rates would not depress investment or spending. European economy should be ignored. So again, that's dovish. So overall, basically, as you can see from here, overall it's a pro-dollar. Okay. Now, initially, obviously, the US markets rallied on the good news, as one would expect to a certain degree. But then once they realised and understood that obviously higher rates is obviously negative for the economy, so then the market started to sell off, and adding the fact that you had some concerns out of Greece as well. Apparently there's a deadline now till February 16th where they can apply for funding. If they don't, then obviously there's talk of them being kicked out. Greece must apply for bailout extension by 16th February at the latest to keep EZ financial backing. Okay, so Eurozone financial backing. So that's not exactly bullish news, is it? And that's what caused the late sell-off. But we did bounce back, obviously based on strong data, economic data. So that's going to be very interesting. We had Greece long-term ratings lowered by 1 notch, so obviously S&P downgraded Greece, so that was a temporary negative scenario. S&P Greece to B negative watch. So again, that's the S&P downgrading. Okay, I think that's sort of a summary really. Okay, so basically pro dollar. Okay, that's from a long term perspective. Not even long term, but looking at from the US market perspective, given the fact that you got higher rates, will actually obviously pose a negative effect, and a lot of that was factored in, to be honest with you, given the fact that the Nasdaq rally fell by almost 40 points, and the S&P fell as well. So it's going to be a debate of whether or not a strong dollar and a strong economy. I mean, technically, well, fundamentally speaking, just purely from fundamentals, a strong dollar is positive because from the economy perspective, that's if they can shake off the concerns of the economy not doing well. Now, if you have wages increasing, if you have economic activity increasing, if you have jobs increasing, that all means higher disposable income, more goods and services are consumed, and the consumer is strong. And we all know 70 to 80% of the GDP of an economy is based on disposable income. So therefore, that's overall strong. If investors believe that the economy is strong enough to come off the Kool-Aid, that's basically a big if. Okay, so if the investors believe that the economy is strong enough to come off the Kool-Aid, and the market will perform by itself without any government or neoclassical or Keynesian philosophy of intervening in the markets, whether you want to go back to Adam Smith's concept of laissez-faire, and obviously it's a free market, and the market itself will decide and will come to an equilibrium between buyers and sellers, and obviously that in and of itself will obviously resolve the problem of weaker growth. Now, if you believe that, which I think the current administration in America, and I think globally now, believes in the neo-Keynesian school of thought or neoclassical school of thought, really is that the markets do have a certain degree of obviously of laissez-faire, so they operate freely. But obviously, when the markets do get depressed and fall into a recession, you can reduce the period of recession or depression, so that the peak can start to rise or come back into play as opposed to a trough. So there's certainly that aspect of it. So obviously it's debatable whether or not that works. Again, if every central bank is attempting QE or attempting intervention, then it certainly neutralizes that effect. But again, that's debatable, and we'll leave that for another day. Okay. Right. So where have we got to? Okay. So strong dollar, okay, has pros and cons. So it's a double-edged sword now. Okay. So it's whether you're you're in two camps. You're either in the camp that this market is not strong enough to sustain itself, and it's not strong enough to come off the life support machine, or off the morphine, or off the Kool-Aid patches. Then obviously your concept or your thought process will be strong dollar, strong economic activity, or strong or positive data is bad news because it reduces the chances of Kool-Aid, or it pushes rate hikes forward as opposed to backwards. Okay. If you're of the school of thought that obviously a strong economic activity, well, number one, strong economic activity means stock market's higher, means dollar higher, means USD JPY higher, euro lower, okay, and every other currency versus dollar lower, and that will have a positive effect, and technically or fundamentally that's what's supposed to happen in textbooks. If you're of the other school of thought, which you believe the markets can't sustain themselves, cannot live to see tomorrow, then and we're in need of the Kool-Aid, and it's very important because higher rates will obviously depress any activity or any growth that's already been achieved, then basically you'll have a bearish view. Okay. Now again, it's going to be debatable, and we have to see whether or not the US economy can sustain itself and can actually move higher, because again, I'm not going to take any sides here. We're just traders, and we'll react and trade accordingly. Now, that's one aspect of it. The other aspect is that Greece obviously dominates. So Greece is dominating proceedings, and Greece is dominating sentiment, etc. in the markets. And as we can see that, which is evident, because that's what caused the temporary sell-off when we had the S&P downgrade. We have talked about Greece having till the 16th of February to obviously renew their commitment, etc. to the Eurozone, so on and so forth. Okay, so that's another scenario altogether. And obviously the Germans not being on board and X, Y, Z. Okay, so that's the other aspect. So we have to ascertain, first of all, whether or not this US economy, with USD JPY moving higher, I mean, this is one of the aspects which I'm going to highlight to you, this is one of the arguments you can use for a bullish market, because we all know the markets are moving inverse to the yen. So if I bring up my yen chart, for example, okay, so if I bring up my daily chart of the yen, you can see here that we've put in the topping tail, now we're on the verge of breaking lower on the yen. And we all know if the yen goes lower, what happens to the stock market? It basically goes higher, because obviously the USD JPY trade kicks in, and the market's S&P follows USD JPY. So we've had our obviously little rally here, I mean, it's not a little rally, but quite a substantial rally. Okay, and basically the music stopped now for the yen rally, and now we're looking for a potential, obviously, move lower. Okay, on the yen chart. So this is basically what we're looking for, and obviously a thrust lower. Okay. Now that's the interpretation, that's the perspective in terms of arguing for the US markets to move higher. Okay, and obviously a strong dollar is representative of a strong economy. Strong economy, obviously the markets continue to move higher and push higher and are strong enough to come off the Kool-Aid. That's one aspect. Now we have socio-economic concerns. So socio-economic concerns, which I've explained to you, are the situation in Greece and whether or not Greece will be allowed, and because obviously we had the ECB cut off the debt line or the bond line midweek. Okay, so they can no longer use bonds as collateral. So again, that obviously reduced their bargaining power. Okay, prior to their meeting with Germany, and obviously that didn't go too well either. As Mr. Schauble said, that they basically couldn't even agree to disagree. Okay, so let alone agreeing to agree. So this is not obviously the primary or the ideal scenario. So you have that aspect. So socio-economic concerns. Then you have the geopolitical concerns, because we had talks with regards to Hollande, Merkel, and Putin late Friday or Saturday, and basically they didn't come to any agreement. Okay, so that's another caveat or another curveball that we have to take into consideration. Also, given the fact that we've had China down quite substantially, so as we know, China was down quite substantially over the over on Friday. Okay, so that's a risk-off scenario. Okay, so again, we have to consider that and contemplate that as well. Okay, so that's going to be another potential curveball that we have to discuss and try to interpret as well. So again, something that's debatable, something that really needs to be looked into. Okay, and we'll see exactly how the markets react. I mean, I'm going to keep a neutral stance. I just want, once I realise that the market's basically reacting the way it is now, then obviously I'll adjust my position, and like I said, I'm not a permanent perma bull, or I'm not a perma bear. I'm very flexible, and I'll adjust accordingly. So now that you know that, obviously we have number one, the situation with regards to Greece. We have the situation with regards to Russia, Ukraine. Then we have the situation with regards to the actual the US dollar. Okay, and obviously whether or not the Fed or the FOMC remains hawkish, dovish, and we'll see exactly how they try to play that down. Because from my perspective, there's already been a rate hike, because the dollar itself has surged quite substantially. So whether or not at this right shoulder on the 60-minute chart, Miss Yellen now starts to promise that she'll hold rates forever and ever and ever, and obviously that causes a negative spiral on the US dollar, or whether some more economic data comes out negative and that starts to push rate hikes back, and then obviously the US dollar starts to fall. Again, that's debatable, and we have to see how the markets react, because it's all about market reaction. If the market interprets that higher rates are negative, and obviously you need to depress any growth that there already is, then obviously that's going to cause a sell-off in the stock market. Alternatively, I mean, the US markets could be very bullish, and the markets could be interpreting a strong economic data as being bullish for the economy, and they want to buy growth going forward. But all of a sudden, Greece puts a stop to that and creates a black swan event, and the markets sell off. So again, there could be any other event. There could be any other event. I mean, there's a lot of fear now brewing with regards to Israel, and obviously Israel and its borders. So in Iran situation, or could be Palestine situation. Could be any one of those. There's been fire back and forth between Israel and Syria. That could be that fire could easily light and obviously cause a risk-off scenario. Or alternatively, you could get a sudden drop in oil again, and that could cause a risk-off scenario. So again, that forces funds to liquidate that are obviously exposed to commodities and so on and so forth. So anything can occur. There's nobody that can sit here and tell you this is going to happen, that's going to happen. Unfortunately, trading isn't like that, I'm afraid, folks. You have to be flexible. You have to adjust. And obviously we have to react accordingly. Again, we had some weak economic data on Friday with regards to Germany, and that caused a sell-off. And you already know with regards to the German DAX, I've already highlighted the pattern. You got heavy H&S formation. So again, it's all debate, it's all relative, and it's all dependent upon the economic news flow. So those that claim that, oh, TA tells you this, TA tells you that, ignore the news, and it's all noise. I'm sorry, that's incorrect. Okay. And the reason why a lot of them say that is because they don't understand the news. Okay. They probably don't have an economics or business background, and they don't know how to interpret the news flow out of central banks, or obviously the news flow out of the market in terms of economic data and so on and so forth. Okay, so it's about educating yourself with regards to fundamentals and technicals, and they act as filters to filter out the noise, and then obviously you have intermarket analysis that gives you an additional filter and filters out even more noise, so thereby allowing you to read the markets correctly. I mean, I call this market based on economic news flow, and obviously, like I said, with regards to Greece, that will be a concern, geopolitics and weaker economic data, and that's exactly what happened. I had identified the pattern, but the pattern needed a fundamental catalyst, and the fundamental catalyst was obviously there, because Germans opposed the Greece, obviously, resolution, and on top of that, you had weak economic data out of Germany, so you put the two and two together, and it creates a risk-off scenario, adding the fact that the Nasdaq was into resistance, and so on and so forth. Okay, so that's how we're working. We can't see a TA pattern and rely on the TA alone. The market could reverse quite powerfully. So you need a fundamental catalyst. Without that FA catalyst, it's just a pattern. Okay, that's all it is. And we already know what fundamental traders. I mean, 89% of traders are fundamental, and they call us witch doctors or voodoo dolls. I mean, this is totally oblivious to them. Just a few candlesticks and lines and same with Ellioticians. I mean, one Elliotician will never agree with the other one because they don't know where their wave starts and finishes. Okay, I mean, a lot of them don't even count the waves properly. I mean, any Tom, Dick, and Harry can say this is A, B, and this is C, and wave 1 and wave 2 and wave 3 and wave 4 and 5, 6 and 10 and 20 and so on and so forth. So it's every science I respect, but you have to take it with fundamentals. That's my argument. Okay, without fundamentals, unfortunately, it's going to be very, very hard for you, unless you're scalping the market and you're looking for is just a certain level to hold and you put a small stop in, and I respect that. That is a strategy, but it's not trading as such. All you're doing is basically playing the probabilities. Okay, but obviously when you're trading itself, and which majority of traders out there trade on fundamentals, then it gives you the ability to amalgamate the two, and obviously gives you the ability to work. I mean, I can just testify myself. I mean, this week it's 100 plus points. Last week 100 plus points. It has been very hard to trade as of late, but on average I average around 200 points a week using fundamentals and technicals. So all those that claim that fundamentals don't work and it's noise, I'm sorry, that's certainly no truth to that argument. Okay, but again, I respect everybody's trading strategy, folks. All I will say is I do this and it works for me, so whatever works for you, and if you don't have knowledge of fundamentals, or you don't have an economics background, or a degree, or you've not studied the subject itself, then I can understand your plight. Okay, but all I would say is definitely always look to educate and empower yourself and increase your understanding. Okay, either way, I mean, my tweets are full of interpretation of fundamentals, so I'm always tweeting out and what I think, and in terms of risk off and risk on. So certainly follow with regards to that, and I'll try and help my best, or try and help from my perspective to the best of my ability for you to understand. Okay. Right, so going back to technicals now, let's try and review the US markets. Now bear in mind the HNS and the DAX, so we'll take that into consideration. So exactly what's happening. Okie dokie, so just to start off with regards to the US markets, we do need to make you aware that the Greece situation will make Europe more vulnerable than the US, because in reality, what's Greece? It's a poxy little country. Yes, it's going to affect sentiment in the short term, because obviously European markets being under the cosh, you generally mean the US markets are certainly under pressure. But having said that, given the fact that the strong economic data negates any geopolitical, socio-economic concerns that the US might have, you will have more of a reaction in Europe than you will in the US. So from my perspective, if you ever see a Greece dip, or you see the market sell off on Greece, then from my perspective, I would like to be buying the US markets. Why? Because I'm buying that, buying strong indices being sent down by a third party, as opposed to obviously inherent organic weakness. Okay. So from my perspective, US markets remain bullish, hence the reason why I bought the Nasdaq on a Friday, looking for a bounce, or on the sell-off late Friday, looking for a bounce going into Monday. Okay, right. So where are we? So let's start with the S&P 500. Okay, and this is going to be interesting. Okay, so daily chart, horizontal resistance. We have to respect that for now. But again, this could just be consolidation, so we're going to keep an open mind. So either we go like this and this, or we go like this. Okay, so make your mind up. So given the fact that you've got a QE put from ECB, you've got Japanese yen obviously for stalling, and the USD/JPY making a high. I mean, look at this thrust higher. It's broken out this downtrend. So if the USD/JPY is breaking out this downtrend, what do you think will happen to the S&P 500? That will also break out this downtrend. So therefore, from my perspective, this is bullish, and this is bullish for the US market and obviously the S&P 500 as well. Your next level of resistance you're looking at is 120, and then after that you're looking at 122 and potentially even higher. And can you see the same? So can you see how the the USD/JPY has just been consolidating sideways, potentially held this double bottom here, and now looking for a potential move higher, folks. Okay, and also you have this bullish continuation pattern because you've got this left shoulder here, you've got a head here, you've got a higher low here, and then obviously looking for a move higher. Same thing with regards to the S&P. Let's have a look at the S&P. Same thing here, sideways consolidation. USD/JPY is giving you the heads up, saying that we've consolidated sideways. Now get ready for a move higher and a thrust higher. Okay. Adding the fact, like I said, you've got the actual QE put from Europe. That certainly helps and supports that thesis. So again, take that into consideration as well. Okay. Either way, I'm not going to sit here and say this market is definitely going up or definitely going down. I'm just going to react. I'm a day trader. That's what I do. Okay. So it's totally up to yourself how you interpret that. Let's have a look at the smaller time frames. Okay, 60-minute chart. We have our into support, previous resistance equals support. So 2050, solid support. Okay, solid support for now. So you respect that. We failed to hold this resistance level here, so we ignore that. The next level of resistance, from my perspective, given the fact that we're in a bullish chart or channel, you're looking at 2080 being the next potential target on the S&P 500. Obviously, if you break through this here, 2050, and move lower than that, then you're looking at downside targets of potentially, you're looking at 2040 and you're looking at 2030. So there are two potential downside targets. A 10-minute chart, let's have a look. Okay, 10-minute chart, you've got the H&S formation. Okay, so H&S, left shoulder, head, right shoulder. You're looking at H&S formation, and which needs to be respected. If it's a technical pattern, again, it needs to be cut in concert with your 60-minute chart. So if your 60-minute chart holds a 2050 on the S&P 500, then that pattern certainly is negated. And obviously, given the fact that if we break this 2060 level, the neckline is negated, then obviously that trade is certainly out of the equation. So take that, obviously, take it together. Obviously, just be open-minded, and we'll see exactly how it goes. I mean, if we see the Asian markets higher overnight and news flow obviously positive, you've got the QE put on the side or in the background. Then on top of that, you've got European markets higher, etc., etc. It's very hard for the S&P 500 to fall. Okay. Obviously, if the markets are concerned with regards to the higher rate cut, denting growth down the road, or denting any growth that we'd potentially already got, or any stabilization that we've already achieved, and given the fact that Greece remains in the headlines, then obviously that H&S formation will fall. So again, can you see the importance of fundamentals? I can't sit here and say, oh, this H&S formation is now going to play out because of this pattern that I've just seen miraculously drawn on my chart, and it's hocus pocus, abracadabra, and this is going to work. No, it's not like that, unfortunately. I mean, you can disagree with me. From my understanding, with the way in which the school of thought that I've been taught is a disagreement. The Prophet Muhammad, peace be upon him, said that disagreement is a source of mercy, and that's what essentially democracy is. We live in a democracy, and freedom of speech, etc. That's basically what it is. It's having the ability to differ with different trading strategies, different thought processes, different understandings of the market, whether you're technical, fundamental, etc., etc. I'm just putting forward my argument. Don't take that as a attack on somebody else's trading strategy or disrespecting them. No, I'm just airing my opinion as from a freedom of speech perspective, and also I respect it as well if it's working for them. If it is working for you, absolutely fantastic. I mean, you can certainly say that, okay, I'm going to take this high probability trade, set up, put a stop loss above here, and then obviously focus on the next trade. From my perspective, it's totally random. Really, I think the chance of this succeeding is 50-50, 50%. So if you are trading, I mean, you may well be breaking even, or you may have a slight bias towards you, but wouldn't it be better to use more variables or more indicators or more reasons for you to take this short position, i.e. Asian markets down overnight, news flow negative with regards to Greece, concerns with regards to a rate hike and more hawkish statements out of the Fed, then that certainly adds credence to your short position, and you have a higher degree of success. Okay, that's my only argument. Now, from a technical perspective, yes, one could argue, look, you have an unfilled gap below here, you've got the 200 MA here, you've got horizontal support here. That's only, I mean, this is the last bastion of support, obviously, that held here at 2051, where previous resistance equals support, and we are looking for a potential consolidation. You can use your fib level. I mean, technically, I could argue all day long this is going to fall lower. But if Asian markets are stellar overnight, going into Monday. European markets raise all the losses, and Greece situation is resolved, and Ukraine situation potentially a solution has been poised, and the markets focus on strong economic data out of the US, leading everybody out of the abyss. Okay, then obviously that HNS is not going to work. Okay, I would play the long position and obviously look for a potential short squeeze higher. Okay. So gap fill support if we do fall 2040, remember that 200 MA, remember that 2040 key level if this 2050 doesn't hold, and we'll see exactly what transpires. Okay, so let's cross-reference that trade. I mean, we can't just look at one chart and say, oh, this is going to fall. We must always cross-reference and cross-market analysis. That's what I've been taught by my teachers with regards to intermarket analysis. So let's get down to business. Okay, so let's have a look at the Russell 2000, even the 3000 as well. From my perspective, you're looking at the Russell 3000 on a 60-minute chart, and all you can see here, previous resistance equals support, classical technical chart pattern. Okay, daily chart, as you can see, we've broken out there, previous resistance equals support, we've retested that. What's going to happen next? It's bullish consolidation in the upper 25%, looking for a potential move to new highs. Okay, based on strong economic data, that's basically the interpretation there. Russell 2000, again, we've closed the gap. We're just consolidating now. What does that mean? Consolidation. Either we consolidate and we move lower, given the fact that you're focusing on higher rates, obviously denting economic growth, etc., etc. Or if you be in the camp that stronger economic data, obviously means stronger growth down the road, stronger disposable income, higher wages, regardless of what happens with regards to interest rate. This is definitely bullish, because a rising rate environment generally indicates that the markets are bullish, or fundamentally strong, should I say. And off you go to the races. That's if your thought process is such. Obviously Greece needs to be out of the equation, and but having said that, I mean, even looking at it from a fundamental perspective, QE negates any concerns with regards to Greece. If anything, it basically creates more short squeezes, because people take a bearish view, and QE will just basically rip out all the shorts. Okay, this is my perspective. Okay, so again, debatable, and we'll see exactly what happens with regards to the Asian session, and we'll take that accordingly. 60-minute chart, can't really see anything there, to be honest with you. 10-minute chart, 60-minute chart, it's all about previous resistance equals support, and that's basically what we're focusing on. Okay, so here we go, previous resistance equals support, that's what we're focusing on. Okay, righty then, let's have a look at the Dow. The Dow itself, consolidation. Again, we've broken out this downtrend, so one would assume, or one would presume, that we are just consolidating here and looking for a potential thrust higher. Okay, testing out the highs and following the European markets higher. Okay, so the Dow transportation, we can always verify that, okay, and cross-reference that. Okay, so look at a daily chart. One could argue, although at this very moment in time, with regards to Dow transports, that we are looking at potentially making a HNS formation. This is your right shoulder, and the markets are looking to potentially move lower, or we can go and test this high here and obviously break out and potentially move higher. Again, debatable, and that will be debatable based on what happens in the Asian session, obviously socioeconomics and geopolitics. Okay. So that's the S&P 500 and the Dow as well. Now let's have a look at the Nasdaq. Let's see what's happening here. Okay, so you haven't closed the gap yet at 2075 or 2042.75. You are coming into resistance. So again, it's debatable. Will the strong economic data cause the Nasdaq to break higher, follow the European markets to new highs? Okay, that's basically the question you need to ask yourself. Now we can cross-reference that with the semiconductors. Now semiconductors have been in a lower lows and lower highs all the way through. Okay, so is that bullish or bearish? Again, debatable. Either we continue in this lower lows, lower high scenario, but my only concern is the fact that you are making a double bottom. You've not made a lower low or a lower high. You have put a bottoming tail in near the 200 MA, and you are looking to potentially move higher. So you could easily break out higher based on economic data and obviously QE from ECB. And the yen falling as well, and new USD JPY making a break higher. Remember when I said the yen and the US markets are interwoven? Okay, so have an inverse relationship, and if it's going to break lower, then given the fact that you've got a 60-minute chart going to here, and you are looking at potentially putting in a HNS formation here now as well. So you've got this pattern that's clearly being visible. So you've got left shoulder, and you're looking at the head. And then you're looking at right shoulder, then obviously looking for a potential move low, and you've got plenty of gaps to fill below. So again, it's certainly not looking very very bearish in terms of the markets overall. So biotechs, yes, we are testing the breakout. So again, we'll have to see, and we have held a 65 to 75% fib, and we are looking for a potential H&S formation. Again, I'm open to, if, like I said, Greece dominates and the Asia markets are down, and the US markets focus on rate increases being negative for growth going forward, then yes, I agree. Okay, because it's all about emerging markets, and obviously rate hikes to emerging markets. So again, I'm open either way. It depends on what the market wants to focus on, folks, and you'll read that between the lines by the economic news flow and obviously price action as well. Okay, so I think that I covered quite a substantial amount there in terms of the markets. I mean, overall, yes, the markets are into resistance, so we have to respect that for now, for the interim. But again, take it with a pinch of salt, because you've got QE, obviously, in the background with regards to the ECB, and that's certainly lifting. They say a rising tide lifts all boats. So given the fact that the amount of money that's being pumped is going to lift all boats, so especially with regards to QE out of Europe. So that's the scenario that we find ourselves in, folks. Okay, so again, I'm not going to sit here and say bullish or bearish. All I will say is this: is I will react to the Asian markets, I'll react to news flow and see exactly how the markets are interpreted by investors or traders. If obviously we are at 2055 or 2060 and I can see new negative news flow, hawkish commentary, so on and so forth, and dollar spiking or the yen moving higher, or any geopolitical socio-economic event, then I'll be more than happy to go short and look for this gap to close, and then we'll see exactly what happens. So summation: remain flexible. Yes, technically you are into resistance on several indices, but that doesn't necessarily mean that we move lower. Okay, it's all about interpretation, of what that jobs data was about, and usually one day is not sufficient enough to interpret and understand. So let's wait till Monday and let's see exactly how the markets react. From my perspective, I bought the dip on the Nasdaq based on primarily due to the fact that the economic data was strong and the markets were totally ignoring the fact that it's actually going to be bearish. So from my perspective, I would definitely look to move on the upside. Although I can't ignore this pattern. This pattern should not be ignored. You've got a left shoulder, you've got a head, and then you've got a right shoulder Nasdaq. So we are looking for potentially retest the neckline at 4233. We'll see how the market reacts, and then we'll see if it wants to continue its move lower. Again, I am very, very flexible. I don't have an opinion in any one particular direction. Yes, you had a rising contracting wedge, and the wedge is obviously broken to the downside, and one could argue, given the fact that you potentially close the gap up there, and you are looking for making a H&S formation on the 60-minute chart. There's your H&S, looking for a right shoulder and obviously move down. Again, I'm not going to focus on one particular bias. I will be open to the market and allow the market to dictate, because that's how the stock market works. Okay, folks, so risk on, risk off, wax on.